As you might expect for a central bank that has kept interest rates on hold, there is both good and bad news in the Reserve Bank's latest assessment of the economy. To the good news first. The RBA's latest quarterly statement on monetary policy predicts Australia's economy will keep growing at about 2% a year for the foreseeable future. A key driver of that is expected to be housing investment, forecasts of which have been upgraded again as the federal, state, and territory governments continue to push towards a highly unlikely target of 1.2 million new homes built before the end of the decade. The bank's latest forecast suggests last month's shock increase in unemployment to 4.5% was merely a blip, with a jobless rate expected to remain steady just below that level for the next 2 years. And the productivity of workers is also improving more quickly than previously hoped, although still topping out at levels that would have been deemed decidedly mediocre a couple of decades ago. The bad news: despite solid economic growth, stable unemployment, and rising productivity, the bank has not meaningfully upgraded its wage growth forecasts. Worse still for workers, tight capacity in the economy means that inflation is forecast to remain higher for longer. The RBA described last week's September quarter inflation figure as notably higher than expected, adding that while part of this increase is expected to be transitory, it also suggests that there could be a little more underlying inflationary pressure than we previously thought. The bank expects the latest annual jump in consumer prices to top out at 3.7% next June. Compared to an expected 3% rise in the wage price index, this is likely to see workers' purchasing power fall again next year, having only just started to recover from the post-COVID cost of living crisis. That cost of living crunch is unlikely to be eased much by the RBA. The market has slashed its forecasts for rate cuts since the last SMP. The cash rate is now tipped to bottom out at 3.3% sometime next year, just over one 25 basis point cut from current levels versus previous expectations of a low at 2.9%. As the RBA notes in the SMP, even this may be generous. The cash rate is now below central estimates of the neutral rate from some models. And the central bank notes there is a growing group of economists who believe its work is done. The median expectation of market economists is for no cuts through to the end of next year. HSBC's Paul Bloxham is one of those who thinks the RBA is finished cutting. We think the next move is up, but we think the RBA is now going to have a long period where it remains steady, he told the business ahead of the RBA decision. So we've got them on hold through next year, 2026, and rate rises penciled in for 2027. One thing that is helping borrowers, at least those who shop around, is that competition between the banks and cheap money on global markets has seen spreads on variable rate mortgages compared to the cash rate fall to about 0.65 of a percentage point below pre-pandemic levels. In plain English, that means that the current cash rate of 3.6% is resulting in the same mortgage rates as a cash rate of 4.25% prior to 2020. The downside of this is that it's hard to see these spreads going anywhere from here but up as banks look to improve profitability or if markets suddenly decide to increase risk premiums to more normal levels. There is a very real possibility that Australian variable mortgage rates are now as low as they are going to get, at least over the next couple of years. If Charles Dickens were around today and contemplating a novel on the state of world affairs, he may well begin thus: "It was the best of times, it was the worst of times." For rarely have we seen such a stark contrast in the collective moods of our leaders. Talk to political observers and there's almost unanimous agreement that things haven't been quite this dire for the best part of a century. War has been raging across a wide front of Eastern Europe as Russia doggedly pushes on with its brutal, never-ending one-week war against Ukraine, while Israel has only just halted its 2-year obliteration of Gaza. China continues to flex its military might with neighbors, Japan, Vietnam, and the Philippines over disputed territory in the South China Sea, all while eyeing off a potential invasion of Taiwan. Meanwhile, America has troops on the streets of its cities, is ramping up a trade war with friend and foe alike, and issuing menacing overtures that hint a military action in Central and South America. Compare that to the world of finance, where, if the markets are correct, there's absolutely nothing to worry about. In fact, things couldn't be peachier. Wall Street is sitting a whisker below record highs, having surged an incredible 37% since it cratered in early April on fears US President Donald Trump's Liberation Day tariffs would tip the globe into recession. Last week, the world's biggest company, chipmaker Nvidia, became the first corporation ever to top 5 trillion US dollars in market value. Apple joined Microsoft with a value north of 4 trillion US dollars. Even more incredible is the action on global debt markets. The normally large interest rate penalty for ultra-risky borrowers has been whittled right down. There's now barely any gap between safe and dangerously risky loans, and is the narrowest it's been in almost 3 decades. Lenders see almost no risk at all. This has been a boom for everyone. Even those convinced that financial Armageddon is just around the corner have done well. Gold prices have rocketed in the past 2 years. There's an old saying that stock markets are built on a wall of worry. Every boom brings forth the doomsayers. Some economists, it is often joked, are noted for calling 8 of the last 3 recessions. But as stock markets continue to unshackle themselves from traditional valuation methods, there are plenty of cool heads getting nervous. Last week, Reserve Bank of Australia Governor Michele Bullock issued a blunt warning on the state of financial markets. People are thinking, well, could it all end up very badly? She told an annual dinner of senior economists. There's sort of no answers there, but people are just a little bit flummoxed about why credit spreads are really low. The risk premiums are really low. What is it that the markets are so comfortable about? They just think that there's going to be no bad outcomes here. I think some people are worried that might all end in tears. She's in good company. The heads of 2 of the world's biggest investment banks, Jamie Dimon of JP Morgan Chase and David Solomon of Goldman Sachs, talked of bubble territory and investor exuberance, while the Bank of England and the International Monetary Fund echoed the very same fears. And still, stocks soldier on. For the past few years, Wall Street and the rest of the world's equity markets have been dragged along by a mere handful of technology stocks known as the Magnificent Seven. For the past 2 years, those gains have been driven by growing expectations about artificial intelligence and the extent to which it will reshape our lives. A few months ago, Microsoft expected to spend an astonishing 100 billion US dollars this year on AI development, but last week revealed it had shelled out 35 billion US dollars in just the first quarter. Meanwhile, Google, Meta, Tesla, Apple, and Amazon all have promised similarly huge lifts in AI expenditure. Until now, Wall Street investors have been happy to let them rip when it comes to spending. But at some point, that spending has to generate returns. And if Silicon Valley's streets aren't paved with gold by the end, it seems almost inevitable there will be some kind of reckoning. Of course it is. It's always different. Until it isn't. It's difficult to avoid comparisons with the last great tech boom around the turn of the century when internet was just taking off. When the crash finally came, it ran a wrecking ball through Wall Street and the legions of companies that had hitched their wagon to the train to glory. The US Federal Reserve was forced to slash interest rates and embarked upon a long campaign of propping up financial markets. In addition, addiction, it has yet to wean itself off. A key measure of market health is now flashing red, just as it did back then. If you want to buy a stake in America's top 500 companies via an exchange-traded fund, you'll be paying 41 times their underlying cyclically adjusted earnings. That's expectationally expensive. In fact, the only time it has ever been higher is during the dot-com bubble, and even then, it was only marginally higher. But there are some mitigating factors. The difference now is that many of those companies leading the charge today are extremely profitable, whereas back in the dot-com boom, many were startups that merely burned through investor cash. When things turned pear-shaped, they went belly up. There are other differences too. The phenomenal rise in asset prices this century is a direct result of the amount of cash that has been injected into the system. The supply of money usually expands as an economy grows, but as the graph above shows, it is now almost 6 times greater than during the 2000 tech meltdown when the US Fed decided to pump up the cash volume. The curve steepened again after the global financial crisis and then went vertical during the pandemic. That tiny little downturn at the top, that's when Fed turned off the tap. But the Trump administration is now running ever bigger deficits with its tax cuts, pumping more into the system, and last week, the Fed gave up on trying to claw cash back. So the spigot is about to open again. Why is this important? Wall Street's performance has almost exactly mirrored the growth in money supply this century. All that money sloshing around needs to find a home. That's why, during the pandemic and in the chaotic Liberation Day tantrum in April, the correction barely lasted a few weeks before resuming its logic-defying rise. It's possible that any correction, no matter how severe, may only be short-lived. Michele Bullock will answer some tough questions today on why the RBA didn't see the higher inflation numbers coming, but she will be secretly counting her blessings that she isn't cutting rates during a stock market boom, and with Australian real estate prices in record territory and once again gathering pace. Central bankers like to tell you they don't take asset prices into consideration when deciding on rate movements, that they concentrate on their two mandates, inflation and unemployment. But they understand better than anyone the link between financial markets and the real-world economy. A market crash strips wealth from households. That leads to lower spending and, before long, a spike in unemployment that can quickly blow up into a prolonged recession. None of them wants to bear the responsibility for that. That's why they have continually pumped up markets, stocks, bonds, and property for the past quarter of a century. But for how long can they keep the elephants intact? As Dickens once wrote, we forge the chains we wear in life.